All right, so we know that the Federal Reserve went and cut earlier this week their federal funds rate by 25 basis points. What does that basically mean? There's a few key indicators that we want to take a look at. The federal funds rate is not the same as interest rates. And one of the main things that we saw earlier this week was they're taking a look at employment and inflation concerns. Now, when it comes to unemployment, we know that when unemployment is low, consumer spending tends to tick up, which means investors usually demand that the bond yields obviously start to diminish. Now, if the treasury yield also increases because of inflation and employment, we will see mortgage interest rates go up, which is what we're seeing. Another thing we're taking a look at is rising wages. Okay, so rising wages keeping up with inflation. Mortgage interest rates are very, very sensitive when it comes to inflation. And the Federal Reserve's rate cuts obviously now have changed. We were expecting 4 cuts. They now changed it to only 2. If unemployment rises, again, that's a potential for the Fed to change their stance. So while the Federal Reserve has been pushing for lower interest rates and lower federal funds rate, we also want to take a look at job security concerns. If people are worried about job stability, demand for mortgage rates may potentially decline. We know the quit rate is at an all-time low and jobless claims is at a 3-year high. We know also that the Federal Reserve has that real 2 main mandates that we've always talked about, inflation and employment. A labor market, again, changing stance could potentially change the Federal Reserve's change. Now, again, another thing we look at is consumer confidence and just overall housing demand. For quite some time, we have been dealing with a shortage of supply and a very high demand. We know that usually higher demand could push potentially mortgage interest rates a little bit higher, with supply being a little bit less. Just like on the flip side, if high unemployment usually will slowly slow confidence, which could potentially change the stance for the Fed. Again, the federal funds rate directly impacts short-term rates. Although it does eventually have an impact on long-term rates, what we're seeing now is the change is going to be in the prime rate or the SOFR. Credit cards, personal loans, ARM mortgages, HELOCs, all those small, really short-term loans, also influenced by the SOFR, secure overnight finance rates. Those are the things. Now, again, the federal funds rate, once it increases, usually that means that the return on some of the short-term saving accounts will potentially also decrease. As wages continue to increase, guys, we're also going to really take a look at if there's any job losses, because the Fed could potentially change their stance if there's a high increase in unemployment. The federal funds rate, as I had mentioned, will directly impact short-term rates. Eventually, it will impact long-term rates. Now, the change that we're going to see between employment, inflation, and a lot of other market dynamics is really going to be the changes that are going to influence the economy. So with that being said, a lot of different things that we need to keep an eye on, and I'll always keep you guys updated.